Welcome to Breaking News to Trading Moves.
Hello.
Today, we are going to look at some recent movements and corporate strategies in the aviation and travel sectors.
That's right. We've been reviewing a collection of material that really centers on one major corporate decision. And from there, you can sort of see how it frames the outlook for the entire industry.
It really does. And the focus today is Delta Airlines. That's DAL. We're looking at a strategic move they're making to really lean into premium travel demand as they plan for 2026 and further out.
And this wasn't just, a statement. It was signaled by a very large, very concrete aircraft order.
Okay, so let's start with the immediate facts. What exactly did they do?
Delta announced a 30-jet Boeing 787-10 order. That's a substantial commitment to their future long-haul fleet.
30 jets, and I believe the commitment is actually even bigger than that, right?
It is. The deal also came with options for another 30 jets.
So they could potentially double that order to 60 new wide-bodies if the demand is there.
Exactly. Gives them a lot of flexibility. But, what really drives the narrative here is the why. It's the rationale that Delta themselves provided.
Right. What are they saying about it?
Well, their message is really built on two different realities happening at the same time. On one hand, they see higher income and corporate travel holding up really well.
Okay, so the high-yield segment is resilient.
Exceptionally so. But on the other hand, they directly contrast that with softer demand that they're either seeing now or expecting to see in the economy, price-sensitive segment.
So a split in the market.
A complete split. And this duality is, I think, the central theme for our whole analysis today.
And before we get too deep into the fleet side of things, we have to mention something else that's becoming more and more important: non-flight revenue.
Oh, absolutely. You can't understand a modern airline without understanding this. Delta is very open about it. They note that the money they make from loyalty programs and co-branded cards is a bigger slice of the pie.
Specifically, their partnership with American Express.
Yes. And we're not talking about a small amount of money here. This is billions of dollars in, stable, high-margin revenue. It almost reframes what an airline even is as a business.
How so?
Well, you could almost think of it as an asset manager that just happens to fly planes. The loyalty program is that valuable.
Okay, so let's drill down into that first part. Delta's strategy and this big fleet investment, it all seems to be built on this idea of premium resilience.
It is. And this is a classic industry example of mix-shifting revenue upward. What that means is they aren't just trying to add more seats to fly more people.
They're being more selective.
They're actively tailoring their product, their network, especially the international rights, to make sure a larger chunk of their passengers are paying those higher fares.
Whether that's in business class, premium economy, or on a corporate contract.
Exactly. The goal is to maximize what's called RASM, or revenue per available seat mile. And you do that by attracting these high-yield passengers.
So it's a strategic choice. It's yield over just pure volume.
That's it. And to support that, they're building out this entire premium ecosystem.
And that's more than just the seat on the plane.
Oh, much more. The components are key. First, you have the premium cabins themselves, like the Delta One suites. That's a hard product that justifies a price that can be, 3 to 5 times an economy ticket.
Okay, so the seat is number one.
Then second is the ground experience. The sky clubs, the lounges. This is a huge competitive differentiator for frequent business travelers.
And third,
the loyalty ecosystem. That's what they're using with that Amex partnership to really lock in a customer's lifetime value.
The lounges are a battleground of their own. I mean, if you're a high-spending traveler who relies on that quiet space at the airport, it becomes very difficult to switch to another airline. It's a physical moat.
It is a moat.
Yeah.
And this whole strategy, this focus on the upmarket customer, it's not happening in a vacuum. The necessary contrast here is what they've acknowledged about the softer conditions in the economy segment.
Right. So while they build up the premium side, they're basically admitting that the traditional budget-conscious traveler is under some pressure.
Precisely. You have this dual reality, a strong top end of the market and a weaker, more price-sensitive bottom end. That's the environment they're planning for.
Okay, so let's talk about the physical part of this plan. The Boeing 787-10 order. Why this specific plane? Delta already operates a big international fleet with a lot of Airbus planes like the A330s and A350s.
That's a good question. The 787-10 is the largest version of the Dreamliner. It's a wide body that's really optimized for long-haul routes, but specifically the ones with high passenger and cargo density.
As fuel efficient?
Top-tier fuel efficiency compared to the planes it will replace. So placing this order is a clear multi-year investment in expanding and modernizing their long-haul fleet. They're focusing on routes, I would guess, transatlantic and transpacific, where those high-yield travelers are concentrated.
And ordering from Boeing, BA also sends a message, doesn't it? Especially now.
It does. It shows a willingness from Delta to actively diversify its suppliers for wide-body jets.
They have strong ties to Airbus.
Very strong. But making a major commitment like this to Boeing gives Delta better leverage. It also helps ensure a more stable supply chain for new planes. In a time when both big manufacturers are struggling with production, having two horses in the race is just smart business.
Now, before we get too carried away with the long-term strategy, we have to look at the immediate market reaction. Airline stocks are famously sensitive.
Oh, they are. That's the paradox of this whole sector. We saw Delta's shares, DAL, they actually fell right after their near-term guidance midpoint missed what analysts were expecting.
Even though the long-term view, backed up by this huge plane order, looks pretty solid.
It just goes to show you, a CEO can lay out a 5-year plan based on premium growth, but the market often cares more about the next 2 quarters.
This sensitivity means that even a good strategic move can't completely protect a stock from short-term worries about the economy or competition.
Exactly. The fact that Delta, which is a premium leader and has that financial insulation from its loyalty revenue, still saw its stock drop on a guidance miss. Well, it shows you how nervous investors can be.
And that really sets the stage for the broader analysis that not all airlines are operating with the same kind of buffer.
Perfect transition. That brings us right to the K-shaped travel market dynamic. This framing is just essential for understanding who is set up to succeed and who might face some pressure.
So the K, what does that really mean?
The K is more than just a letter. It's like a diagram of economic reality for travelers. It represents 2 paths that are splitting apart.
Diverging.
Exactly. The upper leg of the K, that's the higher income consumer and the corporate sector. Their spending is holding up. It's robust. The lower leg of the K is where you see compression. That's the price-sensitive consumer who is starting to pull back.
Okay, so let's focus on that resilient top leg first.
Yeah.
Why aren't these travelers bothered by higher prices or, talk of a broader economic slowdown?
Well, this group includes high net worth individuals and, critically, corporate travel budgets. For them, the demand for air travel is what economists call highly inelastic.
Meaning a price change doesn't really affect their behavior.
Not much, no. A small increase in a flight's price doesn't stop them from traveling. For the wealthy leisure traveler, travel is still a huge priority post-pandemic. And for corporations, travel is seen as a necessary cost of doing business, especially for in-person client meetings.
And this steady inelastic demand is what supports the higher fares we're seeing.
It's the structural support. It means these premium-focused airlines don't have to chase volume by cutting prices. They can confidently charge more for those front-of-the-plane seats because they know the demand is there.
It's like a built-in financial buffer.
That's a great way to put it. Their profitability is all about filling the front of the plane, not necessarily every single seat in the back.
Okay, so if the top leg is thriving, we have to look at the other side. The compressed bottom leg. Who are these travelers and what does it mean when they pull back?
These are your classic budget leisure travelers. They're the ones who are always looking for the lowest possible fare. When inflation goes up and, real wages don't, these non-essential trips are the first thing people cut back on.
They might just not go, or they'll drive instead.
Exactly. They'll defer travel, shorten their trips, or look for cheaper options.
And for the airlines that rely on these customers, what does that compression do to them?
It creates some really tough operational and pricing pressure. It means lower load factors, so planes are flying with more empty seats, and it often forces them into heavy discounting just to get people on the plane.
And their business model can't really handle that.
Not well. If your whole model is based on selling 90% or more of your seats at a low price, any drop in volume just hammers your already thin margins.
Yeah.
They don't have that premium revenue stream to offset the drop in economy sales.
So this K-shape really creates a clear framework for identifying who is set to benefit and who might be in for a tough time.
It's the entire analytical premise. So let's move right into that. Let's talk about the upside, the companies that are set to benefit, the winners.
Okay, so category 1, the premium-heavy U.S. airlines. The logic here seems pretty direct based on what we've just discussed.
It's very direct. If corporate and high-end leisure demand stays strong, these are the airlines that are just structurally set up to capture that high-yield revenue. Their whole infrastructure is already pointed in this direction.
And that infrastructure creates real competitive advantages.
Absolutely. We have to look at the 3 pillars of their advantage. 1, the stronger premium cabins. to the world-class lounges. And 3, which might be the most powerful financially, their loyalty ecosystems.
That loyalty program revenue is so stable, it's money they get even when people aren't flying.
It provides a level of stability that is just unprecedented in this industry.
Okay, let's name the companies here. We have to start with Delta Airlines, DAL.
Delta is the one initiating this strategy, and they are the primary beneficiary. Their success is so heavily tied to that American Express partnership. Some estimates put the annual revenue from that deal in the range of $5 billion.
$5 billion, and at very high margins.
Extremely high margins. It's almost like a recession-proof revenue stream.
Then there's United Airlines, UAL. How are they positioned to benefit?
United has been very aggressive in investing in its international network. They're targeting premium demand across the Atlantic and the Pacific, which are key routes for big multinational corporations. They've been upgrading their United Polaris' business class product to compete head-to-head with Delta for that corporate business.
So a very similar strategy, just focused on their own global network.
A parallel move, yes.
Okay, now the third one listed here is Southwest Airlines, LUV. This one is a little different. They're a low-cost carrier, not someone you'd normally call premium. So why are they on the winners list?
This is a really critical distinction to make. Southwest doesn't have a lie-flat business class seat to London, but their strength is in the domestic frequent flyer market.
Okay.
Their loyalty program, Rapid Rewards, combined with their very reliable high-frequency network and customer-friendly policies.
Yeah.
Like no change fees. That appeals very powerfully to the high-value domestic business traveler.
So they're not premium in the luxury sense, but they capture a premium, less price-sensitive domestic traveler.
Exactly. They sit higher up on the domestic K. They're insulated from the really intense price wars that are happening at the ultra-low-cost end of the market. They're capturing a demand for, let's call it, premium reliability.
That makes a lot of sense. Okay, the second category of winners flows right from Delta's big announcement.
But
Widebody aircraft and key aerospace suppliers.
And the logic here is very simple. Delta's 787-10 order provides immediate, measurable support for the production side of the industry.
Which has been under a lot of pressure lately.
A lot of pressure. Supply chain issues, quality control concerns. So this order helps solidify the outlook for widebody manufacturing for years to come. It's a stabilizing factor in a notoriously volatile sector.
It shores up their backlogs.
For sure. And as we said, the order signals that long-term supplier diversification is happening, which is structurally positive for the whole aerospace supply chain.
So let's look at the direct beneficiaries. Boeing, BA, is the obvious one. They get the order for 30 jets with options for 30 more. That's a big financial boost and a strong vote of confidence in their wide-body program.
Then you have to look downstream from Boeing.
Yeah.
A company like Spirit AeroSystems, SPR, they're a key supplier tied directly to this kind of production.
What do they make?
They manufacture crucial components, including the forward fuselage section of the 787 Dreamliner. So any increase in wide-body orders translates directly to more work, more stability, and a stronger backlog for a supplier like Spirit.
And we also have to mention GE Aerospace. GE, these big planes need big engines.
They do. And GE is a key player in supplying and servicing those engines. This investment in long-haul planes means 2 revenue streams for them. First, the initial sale of the engines.
And second.
And second, and this is far more lucrative, is the decades of sustained, high-margin revenue from service and maintenance contracts. A 787 order isn't a one-time sale for them. It's like a 30-year revenue annuity.
Okay, our third winning category takes us completely outside of aviation itself. Travel, loyalty, and card-linked spending exposure.
This is where the money flows back into the financial system. The core logic is that the reliance on these premium products and loyalty programs, it directly benefits the financial institutions partnered with the airlines.
We already mentioned Delta's loyalty program and their Amex partnership driving a lot of their revenue. How does that help the card issuer, American Express?
It's a direct correlation. American Express, AXP, has that exclusive relationship with Delta. This means AXP gets a huge share of the high-value spending from affluent Delta customers, not just on plane tickets, but on everything they buy with that co-branded card.
So more premium travel means more billed business for American Express.
Exactly.
Yeah.
Higher fee revenue, stronger customer engagement. They pay Delta billions for that access because the spending profile of that customer is so valuable.
And it's not just the co-branded card issuer. The big payment networks also gain from this.
Absolutely. Visa, V, and MasterCard, MA, Both benefit. As long as that top leg of the K-shape is spending a lot on travel flights, hotels, rental cars, these networks just capture higher transaction volumes and the fees that come with them. Affluent travelers simply spend more.
So a strategic move by an airline is a boon for the financial companies that serve the global affluent consumer.
That's the ecosystem.
Okay, so now that we've detailed the winners on the upper leg of the K, we have to turn to the downside, the companies facing headwinds, the losers in this environment.
Right. This is the bottom half of the K, where the economic reality for the price-sensitive consumer creates structural pressure on the business models that depend on them.
And the first category here is the one facing the most direct headwind, the ultra-low-cost and low-fare airlines.
And you just can't get away from the basic logic here. These carriers rely almost entirely on that price-sensitive leisure traveler, the exact group that's pulling back or being extremely cautious right now.
So when discretionary income gets tight, these airlines feel it first.
And they feel it hardest.
What specific market challenges does this create for their operations?
Well, they face a few critical problems. First is weaker pricing. They're forced to drop fares just to try and stimulate demand. Second is tougher load factors, which means their planes fly less full. That's fatal for a URCC model that needs every seat filled to work.
They don't have that premium buffer. An empty seat for them is just a total loss.
It is, whereas a premium carrier might make up for 10 empty economy seats with one high-yield business class fare.
Let's talk about the companies named here. Spirit Airlines, SAVE, is listed as particularly vulnerable.
Spirit has faced a combination of challenges. They've had fleet grounding issues, but their business model has this high exposure to the budget leisure market. They are caught in this dynamic of needing to offer the lowest price, even as their own costs for fuel and labor have been going up.
Their margins are getting squeezed from both sides.
That's right.
Allegiant Travel, ALGT, is also in this group.
Allegiant's model is very specific. They do point-to-point service, often to smaller airports, and they are targeting leisure travelers who are looking for value. When that specific consumer group hesitates, Allegiant feels it immediately, both in their capacity planning and their pricing power.
And finally, Sun Country Airlines, SNCY.
Sun Country operates on a similar premise, a heavy reliance on the budget leisure segment. Their exposure to this compressed bottom leg of the K makes them vulnerable to all the pricing volatility and load factor challenges we've been describing.
So when the low-end consumer is cautious, these three carriers really bear the brunt of it.
They are on the front lines of that pullback.
Okay. The second category of companies facing pressure isn't actually airlines. It's the infrastructure that serves that cautious consumer. Economy-skewed travel booking and price comparison platforms.
The thinking here is that these platforms are built for volume generated by value-focused travel. So if the lower-end consumer is cautious, their core market shrinks. Fewer budget trips means fewer transactions for them.
And the challenges for them aren't just about lower volume, are they?
No, it's also about the cost of stimulation. So they anticipate softer volumes, which hurts revenue. But to fight that, they often have to get into heavier promotional activity, more discounting, more marketing, to try and convince that cautious consumer to book a trip.
And all that marketing spend eats into their profits.
It erodes profitability, even if they manage to keep the transaction numbers from falling too much.
We see this applying to Expedia Group, EXPE.
Expedia operates a huge portfolio of brands, and many are tied to value-focused and discretionary leisure trips. Their revenue is linked to the volume of hotel and flight bookings from this broad consumer segment. When the budget traveler pulls back, Expedia's booking numbers suffer.
And TripAdvisor, TRIP, as well.
TripAdvisor's platform is built around researching and comparing value-focused travel. When budget travelers delay their plans or choose cheaper, local options, the platforms that aggregate those budget options feel the pinch directly. They rely on referral fees and advertising, which both go down.
Okay, so finally we get to the third category of losers. Airlines with less premium mix or higher sensitivity. Now, these aren't the ultra-low-cost carriers, but they also don't have the financial armor of a Delta or a United.
This is sort of the messy middle of the K. The idea is that these carriers lack that robust premium insulation that the winners have. This makes them more exposed to swings in general market sentiment.
They just don't have enough high-yield revenue coming in to absorb shocks from the economy segment.
Exactly. And that translates into thinner operating margins compared to their premium-heavy competitors. We saw how even Delta's stock reacted to a guidance miss. For these carriers in the middle, any bad news gets amplified.
The market punishes them more.
Disproportionately, yes. Especially those perceived as having thinner safety nets or less pricing power.
Let's discuss JetBlue Airways, JBLU.
JetBlue has always positioned itself as offering a high-quality service at a lower cost than the big legacy carriers. But they haven't really built out the massive international corporate network or the huge loyalty program revenue streams that you see at Delta or United.
So they're more exposed.
They're cited as facing these amplified sentiment swings because their revenue is more weighted toward domestic leisure. And while that's a higher quality customer than the ULCC segment, it's still more volatile than global corporate traffic.
And American Airlines, AAL, is mentioned in a similar way.
Yes, American is a legacy carrier, but analysis often points to them as having less powerful premium insulation compared to Delta and United. While they certainly have a corporate business, the market perception is often that their loyalty program is less of a revenue driver.
So their overall revenues are more reliant on just filling planes and less buffered by that premium yield.
And that exposes them to greater volatility when the market is splitting so clearly like this.
This whole K-shaped analysis really clarifies who is prepared for a choppy economic environment and who isn't.
It does. Delta's move and the resulting market dynamic show how these macroeconomic trends create clear winners and losers. It all comes down to your revenue mix exposure.
The difference is whether you can rely on premium, corporate, and loyalty spending versus being over-reliant on the budget traveler.
It really reinforces the idea that generating reliable non-flight revenue through a loyalty program is now, well, it's an operating necessity. You could argue it's just as important as the ability to fly planes efficiently.
It's the ultimate insurance policy against a downturn.
I think so.
So, as a final thought for you, the listener, we'll leave you with this to consider on your own. Think about whether this current intense focus on premium loyalty ecosystems represents a permanent evolution in airline revenue models. Is their success now truly decoupled from just selling tickets? Or is this just a cyclical, tactical response to the current economic uncertainty?
That is the long-term question for valuing this entire industry.
Before we go, please note the following. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.